lowering the carbon footprint of your portfolio, either to make yourself feel better or to lower risk, is a good idea, right? So that's kind of been the one in the front. Now the social aspects are coming more to the fore because of COVID, because of Black Lives Matter, because of lots of reasons. People are saying, well, we should really pay attention to the social aspect.
Hello and welcome to a new episode of the Bull Club, conversations with leaders. You can get valuable insights from successful investors and financial leaders worldwide. My name is Sam North, a market analyst at eToro, and I'm happy to be your host today. Our topic today is all about ESG investing. Over the last few years, ESG has gotten more popular, with investors and companies making a considerable effort to make changes. And there have been some predictions that ESG investments will reach 50 trillion by 2025, or a third of all money invested globally. Our guest today is Sam Adams, who is the CEO and co-founder of Vert Asset Management, a dedicated ESG investment management firm, and he is also the co-author of the book, Your Essential Guide to Sustainable Investing. With Sam's passion for this area and extensive experience, we're in the perfect hands for this conversation today. Sam, how are you? Good to have you with us.
Thank you, Sam, very much. Thanks for having me on the program.
Yeah, no, looking forward to it. I mean, look, as I just mentioned, our subject is going to be primarily on ESG. For those that aren't familiar with that, can you give us just a quick overview of what that means to you?
Yeah, so ESG stands for environmental, social, and governance investing. And that's a way for investors and investment managers to look at companies with more information that's available than traditionally just from the financial statements, like the income statement and the balance sheet, et cetera, right? So it's looking at the risks and opportunities that companies face with regards to the planet, how much natural resources they consume, how much pollution they create, and whether as they grow, those are going to become costs or scarcity problems for them. And then around the way they treat their people, whether their employees or their customers or their supply chain, do they have good relationships there, or are there some strife or some trouble there that might cause them problems in the future? And then with regards to governance, how's the company set up? How's the board looking after management? Are they taking care of all the risks that they should be taking care of? So looking at a company in that way gives you additional information that can be helpful in identifying risks in your portfolio.
Amazing. Perfect explanation. I imagine you've said that one a few times before. I've definitely noticed over the last, I would say, year, 18 months, I do a lot of events where we'll do either webinars or seminars, and people will come up and talk a lot about, ESG investing, and they want to know a lot more about it. So it's getting more and more popular. However, there is definitely a claim that ESG has become, should we say, so trendy that some companies might use it just to be favored. Do you have a take on that at all? Is that something we need to consider?
Yeah, it is. But I mean, there's a lot of shock and surprise that companies are doing that, that they're putting on a green or an ESG veneer to look better. And that's, I mean, that really shouldn't be surprising. I mean, if you've ever been on an earnings call or listened to a CEO talk about their company's prospects, right? They're always putting themselves in the best possible light. Everything's rosy. Our products are flying off the shelves. Everybody loves us. Our employees love us. I mean, that's their job, right? Is to sell their company. And then they do the same thing with their products. This is a fantastic product. And so we shouldn't be surprised that if sustainability becomes popular, that they'll start, wearing the sustainability clothes and claiming they're all that as well, right? So just like in all other areas of investing, it's down to the investor to be a little skeptical and just, do your due diligence and make sure that those claims that those companies are making, whether green or performance or otherwise, can actually be verified.
Yeah, that they can back it up. I mean, look, with eToro, we recently offered our clients on the platform an ESG score for most of the stocks. So it'd be like a traffic light system: green, good, yellow, and red, and so on. How important do you think to investors it is now in that decision-making process? Is it on the same level for you as like an earnings report, or is it an addition, but a welcome addition as well?
Well, I think it comes down to the person of what's most important, but I think it is becoming more and more important, will affect the earnings going forward. So I think it's something that you have to pay attention to now, right? I guess maybe 5 or 10 years ago, when we weren't paying as close attention to climate change and to social justice, we were like, okay, those things are down the road. But now we have plenty of examples with the weather and extreme events happening, that this stuff is happening now, and it's changing companies' ability to operate. And so we're at the point where even conventional investors that don't have a sustainability label or an ESG label are using ESG information to tune their portfolios or de-risk their portfolios to those extreme events. So you're going to have to include it at some point. And my opinion is, why not now? Now that you have things like your traffic light scores, why not integrate that into your investment decision? Don't change all of the fundamentals that you do, like, the way you're diversified and what asset classes you want to be and the factor tilts and all those important things that you want. Don't necessarily change all that. But when you're reaching for that investment, whether it's a stock or a fund, why not consider the ESG part, just either to be on the safe side or to express yourself in the way that you want?
Yeah, and I guess if, say, you had a company whose, let's just say, ESG score wasn't great, but they were making plans and had plans in place to improve, in a way that might be, an opportunity where people see, okay, well, if they're not great now, but there is room for development, investors might like the look of that. So I guess as investors, we do need to look what their like forward guidance regarding the ESG is as well. Would you say that?
Check your risk appetite, right? Because those guys that are starting on the journey, they have more opportunity, but they're a little riskier, whether they've, hardened their assets to climate change. But sustainability has a lot of low-hanging fruit, right? Like, if you haven't changed your light bulbs to LEDs, right, you can save a lot of money really quickly, right? So the people who are just starting on their ESG journey, the companies that are just getting onto this, have a lot of room to improve right away, really quite quickly, quite easily, quite profitably. And so there's an opportunity for what we call ESG momentum there to get on board there. And then from a sustainability perspective, if you care about people and planet, right, those companies, the ones that have been lagging, are the ones we really want to get on board, right? So if you're putting your capital with those guys and encouraging them to take those steps, that's a really great thing, right? We're not necessarily in the sustainability game trying to just parse out the winners here, right? We want all companies to get better, right? So I think that's a win-win.
Yeah, for sure. I mean, I mentioned earlier you're a co-author of the book, Your Essential Guide to Sustainable Investing, which was released earlier this year. How did that all come about? And also,
what it looks like, just in case you need to get your copy.
Yeah, we got to get that promo in. Absolutely. We'll put the link below. How did that all come about? And I know you talk about this in the book, but what are the most popular ESG methods that you come across and you believe in as well?
Yeah, well, part of our mission at Vert is to educate people, investors, about sustainable investing, so there's more clarity about it. It's a really confusing space, right? Because it's still relatively new to a lot of people. And so we wanted to write the book to get people a bit more understanding about it, and so that hopefully they'll be more comfortable with it. And so we were really trying to lay down some of the most basic questions about what is it, what's the difference between ESG and SRI, like social responsible investing, and what's the difference between those two types, and impact investing. What are some of the examples of doing that? What's the performance going to be like? Is there any impact? Like, if you move your money into sustainable investing, into ESG, does that change corporate behavior at all? Or are you just tilting at windmills? I mean, what's happening there? And so Larry Swedroe and I wrote the book to kind of answer the investors' basic questions around that.
Amazing. So if we just move on to an investor standpoint, and I know you do cover this in the book as well, but how could an investor tell if their investments have the social impact they want, aside from scoring methods? Is there, a way that they can sort of see this directly?
Yeah, that's kind of the new frontier, right? Of trying to figure out, like, how is this actually working? And
Yeah.
there's a great academic paper if you're into reading those types of things, but the title is wonderful. It's called Can Sustainable Investing Save the World? And it breaks down how sustainable investing influences corporate behavior in 3 ways. And the first one is, if your fund manager is doing active shareholder engagement, i.e. they're calling and writing to the companies and asking them to do better on their ESG performance, that means that your money is going to work directly in influencing the company, right? The second effect is the fact that you and lots of other investors are moving money into these more ESG companies. They get an uplift in their stock price. They get a lower cost of capital. It's easier for them to fund projects. That gives them, some momentum in doing more sustainable projects. That's an effect there. And then the third effect is, I think of it as branding. It's more of an indirect effect, but there's stigmatization when a company has an oil spill or has a scandal or a lawsuit or a recall or something, right? There's benefits to being, one of the world's best places to work. Those types of things can dramatically affect a company's ability to sell products, to hire people, to retain people. And so those 3 effects, the active engagement, the capital flows, and those indirect branding or stigmatization and endorsement effects, are very strong, right? And they're hard to measure, though, right? They're hard to make causal links exactly to measure, but there's good evidence it's happening. If you wanted to see whether your investments are doing that, either look at the fund manager that you're using and saying, is this company doing active shareholder engagement? And they'll usually have engagement reports and whatnot that'll show that. And if you're investing in individual stocks, look at the companies and what they're doing in their ESG reports. And then, after you take out all the marketing fluff, see what they're actually doing.
Yeah. I mean, look, as with pretty much any conversation, there's always 2 sides to it. And when it comes to ESG investing, I guess in this moment, we can hopefully shed some light on some potential risks that people might need to consider going down this route. I actually do speak to some people who say, I only want to invest in ESG related ETFs or funds. And I think that's, great. But what do they maybe need to consider? We've heard the word greenwashing branded about a fair bit. And, I guess if you only want to go down a certain sector, you're not therefore maybe not as diversified. Are these things that we just, investors need to consider?
Yeah, absolutely. And so, nowadays, right, there's an ESG version of almost any asset class or fund or product. So you can get a well-diversified portfolio and all those types of things, but you can take it quite far, which was going to give you more variable performance. Think of it this way. The more you lean into anything, small caps or value or ESG, right, the less diversified you're necessarily going to be. And so you just have to be aware of how far you're going. Now, if you're willing to look very different from the market and it's not going to cause you to sell out or do silly things with your portfolio, that's fine if you can stick with the program. But the case in point is the last year or so, right? ESG has tended to underperform as oil and gas has outperformed. If you're okay with that, that's fine. Just know that that's what's going to happen. If you go into it with the eyes wide open, you're going to be totally fine. And there is, if you only want to invest just in the sustainability leaders, like you said, you could be missing out on diversification on certain sectors. And I don't have a problem with that. I just, I encourage people to be aware that, the ESG stocks aren't going to outperform every day, every week, every month, every year, go for the next 10, 20 years, right? That's not going to happen. There's going to be changes in leadership, and we just need to be aware of that.
Yeah, no, for sure. And I think as long as people do their research and trust their process, I think that's all you can ask for at the end of the day. When it comes to capital allocation, I imagine it's going to be more personal to the individual investors. But are there any trends that you're seeing in terms of what people are doing? And also, do you see any of these certain trends developing further over the next few years?
Yeah, I mean, one of the things that has always been the leader in the ESG piece since 2015 anyways has been carbon, right? People are realizing that there's probably going to be either an implied price or an actual price or a tax on carbon at some point. And so getting that lowering the carbon footprint of your portfolio, either to make yourself feel better or to lower risk, is a good idea, right? So that's kind of been the one in the front. Now the social aspects are coming more to the fore because of COVID, because of Black Lives Matter, because of lots of reasons. People are saying, well, we should really pay attention to the social aspect, which we don't have as good a data on in some cases, but can actually be just as important as the carbon piece. So that's the next thing that's coming within ESG and getting better data on that. And then there's an overall strategy, which I think this is the newest one that's coming on strong now. And it's the idea of aligning your portfolio with a net zero pathway, i.e. trying to get to 2050 in some type of Paris-aligned goal, i.e. getting to decarbonize your portfolio so that you're on track with that effort. You don't want to be behind that if companies are moving towards that and governments are moving towards that. So there's all kinds of new measurements to figure out what's the implied temperature of your portfolio and those types of things. I don't think we have all the mechanics of that worked out quite yet, but that's an exciting new area as well.
Yeah, definitely. I mean, just listening to you say that really excites me. I think a lot of people would actually really care about that and want to see that data in the future. Just how important now is ESG to these big companies and big corporations? Do you think there would be a time potentially in the future where, regardless of how a company performs, regardless of how good the market would have originally thought their earnings report was, unless they have their ESG in order, they won't attract investors? Do you see that potentially happening?
Well, I got to answer that two ways. I think we're already there, right? When you have close to half of European investors integrating sustainability at some level into their portfolios, and close to a third in the US, and probably near a third all around the world. That means when a CEO or a CFO or a board is thinking about their next project or their next product launch or the next factory build, they're looking over their shoulder going, well, there's a lot of our investors who care about this. They're going to ask us these questions, these hard questions about this, like how much water is this factory using and all. So they have to think about that in advance because they know they're going to get the questions, right? So I think we're at that stage where the vast majority of companies are trying to. And if you look at the number that are doing ESG reporting, those are at least large companies. It's all the vast majority of them are doing that now because they've been forced to buy investors. Now, there's something that you said in there that I just want to key on. There will always be companies, sin stocks, tobacco companies and reprobates or deplorable companies or what have you, that people are fine with investing in and people want to invest in. And these guys are going to mint it, because they're skirting the laws. They're shaving close to the regulations. They're treating people poorly. They're not paying anybody. They're going to make a lot of money. And in the short run, that's probably or possibly true. But there's a lot of risk in that as well, right? And so, I don't think that companies that are necessarily really bad at ESG are going to be starved of capital anytime in the future. But they will find it. They'll have a narrowing and shrinking pool of investors to draw from.
Yeah, no, it'd be interesting to see how that all develops. I mean, look, we can't interview a fund manager, not talk about 2022 as a sort of challenging market condition. How have you dealt with that, and how do you see companies with really strong ESG outperforming the market going forward, or potentially?
Yeah, I mean, the thing about ESG and performance is we don't really have the answers that we have with other areas of the stock market. What I mean by that is, if you look back 100 years, we have stock market data on whether equities outperform bonds and small caps outperform large, and value and growth and all those types of things. ESG data goes back maybe 20 years, right? Yeah. It wasn't even invented 20 years ago. And so we really don't have those long-term return series to draw conclusions from. But theoretically, we know this: as more people invest in ESG companies, that will change their equilibrium price. Those prices will rise. And that's kind of what's been happening from 2017 on. But then you have some major events like 2022 where the oil and gas prices go up and those companies outperform, and they tend to underperform. Like I said, this is going to go back and forth. I don't think that the job of the fund managers should be trying to shift too much to try and catch those things. That's really hard to do timing wise. I think that the writing's on the wall with regards to oil and gas. That's going to be a long decline, maybe slow, but definitely a decline. And so you want to set your portfolio up for that in the long term and just be ready for these hiccups, right? Where oil and gas or other things outperform. That's definitely going to happen. But I think the long-term trend for certain favors the companies that are more ESG. Whether that comes in the form of lower risk or higher returns, we don't necessarily know. But I like the sound of both of those, right? So I'm okay with it.
Yeah, absolutely. Absolutely. And I guess with the lack of data, does that maybe make predictions over the next couple of years tough as well to make accurately in all sort of fields as well? Would you say that?
Yeah. I mean, it's hard when you have accurate data like around the financials to make predictions, right? But we don't even have that accurate of data, right? This is one thing that I think investors should really understand when they're looking at an ESG piece of data, like an emissions figure or something. It's indicative, right? But it's not like financial data, like a PE ratio. You can't rank order companies and know that this guy is 17th and this one's 21st. Or that's just we don't have that specificity around the data. So your traffic light thing, which green, amber, red, makes a lot of sense. That's kind of where we are with ESG. We can do leaders, we can do laggards, and we can have some group in the middle that we're like they're doing okay, or maybe they're phoning it in. We're not exactly sure yet, right? That's kind of where we are with the data. But that's good enough, right, to help us build better portfolios and saying this is a group of companies that are really taking a lot of risks in this area. I'm not comfortable with that. Or here's a group of companies that are doing really well in this area, and I want to embrace that. And that's great.
No, absolutely. I mean, look, if you can share with no financial advice, of course, which companies do you find most interesting in this sort of ESG strategy? Are there ones that you really sort of favor at the moment, whether that be individual companies or certain funds?
Well, so one of the areas that we have a sustainable real estate fund, a U.S. mutual fund, and one of the areas that we find really intriguing is buildings that are more sustainable. And everyone talks about the carbon footprint of our transportation system, right? And everyone's gnashing their teeth about, electrification of vehicles, which is great. We seem to be on that path there. But buildings use 40% of the world's energy and create 30% or more of the world's greenhouse gases. So if we're going to decarbonize, we have to look at our building stock. We have to look at our property companies and saying, hey, are you guys doing things to do that? And there's some really good leaders in that. In the UK, in particular, there's a bunch of real estate investment trusts that are doing very well around that. Australia, Europeans, and Americans as well, leading on that. And so look to property companies that have figured out ways to decarbonize their buildings or lower their carbon footprint. And here's why this is such a great story. When you lower the energy use of a building, you lower the carbon footprint, but you also reduce your utility bill, right? So you're saving money, right? And you're also probably saving on maintenance costs as well. And you've made the building a healthier building for people. So it really is that triple bottom line win, right? It's better for people, it's better for planet, it's better for profits. And that's what you want in ESG.
Yeah, for sure. Last question now. And we're going to go down the sort of the sport analogy route. I mean, is there a specific sport that you enjoy the most at the moment that you've done previously?
Well, I'm a climber, so that's the
analogy we'll go for.
Forced analogy. There's not a lot of climbers out there, so that's kind of a forced analogy.
Well, no, I think we can work with it. So if we say we're at the bottom of, I don't know, like a mountain or something, and we're climbing up it, and ESG is that mountain. How early in the climb are we? Are we just getting going? Are we halfway? Are we near the end? Like on this whole journey, is it still so early?
Yeah. Here's the way Larry and I have described that before. When you look at surveys of investors, whether they're interested in sustainable investing. The vast majority of them come in at like 70 to 80% of investors say, yeah, I'd like that my portfolio to be sustainable. I'm interested in that.
Yeah.
And we're at about a third of, global assets are managed for sustainability. So there's a lot of room to go there. Yes. I think more investors will want to, or will, whether they want to or not, use ESG data in the integration because there's real risks and opportunities there. So I think it will become even more mainstream than it is now. We're in the early innings. It's going to grow, continue to grow, and get to over half. We have a kind of a historical analogy with the growth of passive investing, right? Back in the 90s, people thought that was crazy, but a third of institutional money in the 90s was invested in index funds, and then only like 1 or 2% of individual investor money. And now we're kind of at that space too, right? The big pension funds have all embraced, not all of them, but the majority of them are using ESG. But some of the individual investors and financial advisors and wealth managers are still, getting comfortable with it. And so we just think there's just going to be a lot more money coming in here, a lot more products, and the data is going to get better and better.
Amazing. Early in the climb, and I imagine the view from the top is going to be pretty good. Sam, it's been an absolute pleasure having you on talking about ESG and everything surrounding it. I'm sure our viewers will be very grateful. So Sam, thank you very much.
Thanks for having me, Sam.